Welcome to the Southeast Retirement Planners podcast, where we will go beyond the balance sheet with our guests, not only to share from our personal experience as financial advisors of over 25 plus years, but also to learn from our guests about the issues and topics that are important to them. Our firm specializes in taking care of the financial plans for individuals and small businesses by helping our clients identify their individual goals and taking a conservative and ongoing approach to helping accomplish them. We are located in Hickory, North Carolina, and look forward to continuing to serve our clients and our community. Thank you for joining us. We hope you enjoy this week's episode.
This is Ryan Edwards, and I am joined today with Les Stewart. We are with Southeast Retirement Planners in Hickory, North Carolina, and we're happy you're joining us today for the podcast. Today we're going to be covering some of the topics, words that individuals are probably hearing a lot these days on the news and in the different media outlets. Bulls, bears, recession, and depression. So we want to make sure that everybody is knowledgeable about these, and just like any other topics that we've discussed on these podcasts, you can find our past podcasts online at our website, www.seretirementplanners.com. Resources such as this, also past podcasts, are recorded and saved there, so you can check out kind of our library, if you will, and also find out more about the services and our team that we have in place.
Yeah, there's tons of information on there that if you're looking for a financial topic, I'll be hard-pressed that you wouldn't find something there that would be helpful.
That's right. So as we record this, we're in the second quarter of 2022, and it's been a very eventful beginning to the year.
So and been a tough stock market overall. And
we're coming out of what's called a bull market.
Right.
Okay, so a bull market is a kind of like the bull charging forward, running and going full speed ahead, or at least trending upwards.
Right, and I'm not sure I think most people kind of get that that's a positive thing, but the definition of a bull market is a 20% plus positive move from a certain period of time. In the stock market, and that's usually looking at the S&P 500 or Dow, an index that's commonly followed. A lot of people would say the S&P 500. Right. So, in most cases, it's a 20% move in the S&P 500. Right. And it can usually kind of a couple months is sort of the gauge for time period on that.
Yeah, and we coming out of a bull market that was one of the longest we've ever seen.
And quickest, had one of the quickest growth patterns.
Yes, that's correct. So, as we kind of go forward, because of the time we're recording this in, let's make sure we're spending some time on what's a bear market. And
let's just stay in the bull market all the
time. I'd like to stay in the bull market. Our job would be a lot easier if we stayed in the bull market, because people like to look at their statements, and I call it's the blue skies and red roses time period. Everybody's happy and everything's going good. We always need to measure, even during times like that. We've heard clients say, why am I not making more money?
Right.
Well, if you want to have the upside of the market, then you better be prepared to have the downside possibilities of the market as well. And that's what we're really seeing now. Now, not a lot of our clients that we work with are we really managing their risky money. We're really managing their important money, if you will, and
the stuff they're going to count on to live with.
That's correct. Yeah. And let's cover a few things, and you can see on this screen. Now, obviously, we've been going through an uncomfortable time period in the market, but it's one that's not unfamiliar. I've been saying that a lot here lately over the last 3 months, and I know it sounds like I'm on repeat, especially for Les, who hears me say this quite a bit. But this slide is going to show you how these types of declines are a normal part in an investment cycle. Now, it's going to be very important to know that we're talking about market cycles here, not an economic cycle.
That's correct, yeah. Because we'll be talking about economic cycles
in the next two terms.
Yeah, the next two terms. But bull and bear market, you're talking about stock market or bond market. And it actually doesn't even have to be it's a market. You can have a real estate bull and bear market.
Correct. So it's not a wide stroke brush. But what we did do is we pulled this information from a resource, and it's talking about an index, what you just mentioned, S&P 500, and it's covering it from 1949 until 2020. Mm-hmm. So normally, this is average frequency, and people have forgotten this because even like last year, we had very little volatility.
Right.
So a lot of kind of head in the skies, blue skies and red roses. But normally, the average frequency in which we have a 5% or more decline, which is called a pullback, we usually have that happen 3 times a year. Mm-hmm. And that was very rare last year. I mean, and so let's look. Okay, well, what in the world's a correction? Well, a correction usually happens at least one time a year, and that's a pullback of at least 10%.
Right.
So
you just kind of expect that to happen.
Yeah.
I mean, I don't even think we had one of those last year. We may have. I might have forgotten about it, but last year was an anomaly. However, the year before that, we saw several corrections.
Correct, during COVID and everything. Yeah. So now let's talk about one of the words, the bear market. Now, what in the world, how do you define a bear market? Well, a bear market usually happens about once every 6 years.
Right.
And that's a prolonged period of time where the size of the decline is usually about 20% or more.
Right.
So this is nothing, it's uncomfortable, right, but it's not unfamiliar.
So as we're recording this on, what is today's date? It's May
today is
20th.
It all runs together. Yeah, exactly. So
as we're recording this, last Friday, the market touched right above a 20% pullback. Mm-hmm. And then we had a good up day on Monday. So we still are not in an official bear market territory in this pullback. Yeah.
That was some of the headlines that came out on Friday was that, hey, the market officially enters into bear market territory. Right. So you're more knowledgeable now if you're listening because you know what that means. Right. And that means that we went from the highs down 20% or more. And if it would have stuck, then we would have been officially in a bear market.
Right.
And
so, but that one thing to keep in mind is that's an average once every 6 years. Now there could be a 8-year period that you don't have a 20% pullback or a bear market, but there could be a bear market every 2 years, and that's how you get that once every 6 years since 1949. So.
Exactly. So these are averages. I mean, a pullback once a year, a correction of 10% or more. Very rarely does statistics track along the average.
That's right.
So we don't want to get too much into mathematics of this, but
so I'm hearing in the media, we're likely to go in. This bear market's likely to extend because we're bound to, we're headed towards recession or this and that. So all I know, or a lot of people know, is that recession is something terrible.
Right.
And it's not a great thing, but recession really doesn't have anything to do with the return of stocks or anything like that, except that, typically companies aren't doing quite as well, and that reflects in stock price.
Correct. And we do have a lot of things going on in the economy. I've got a publication we recently put out. I mean, we've got a war going on. We've got there's lockdowns for COVID in China. There's supply chain issues. There's the Federal Reserve raising interest rates, employment issues, all those things that are bearing on the stock market and making us that's hurting the economy and making people think that, hey, we might be going into a recession.
But kind of like a bear market or a 10% or a correction, a recession is a normal part of an economic cycle and an economy because, the opposite of recession, once you bottom out of a recession, then you start going up, right?
And usually the stock market is a precursor. It runs ahead of those economic cycles.
That's correct.
So
if you were to look at the two charts pushed together, you would see that. And
the recession is 2 consecutive quarters of negative GDP growth. And we had negative GDP growth in the first quarter. We obviously are in the middle of the second quarter, don't know what it is.
Right, and it's not. We're not certain whether we're headed in a recession, and recessions aren't easily predictable like people think.
No, they're not. That's good. What I hear and what kind of concerns me sometimes is, and it's not true at all.
Mm-hmm.
And one of the most well-known investors of all time was called. He goes by Mr. Sir John Templeton,
right.
and he called the four most dangerous words in investing are, "This time is different."
Right.
And that causes people to act where they make knee-jerk reactions.
Mm-hmm.
And truth be known, these things have all occurred over time, and we're a whole lot more ahead of where we were back then, even with these things we're facing. So, but let's get back on topic here and go towards, cover the recession more. Well, we defined it as 2 consecutive quarters of down GDP growth. And
so the article that I pulled, and this is actually a Forbes article, says that we've had 4 recessions since 2000. Let's see, 4 recessions since 2001. We had the COVID-19 actually was considered a recession, and when you think about what went on then, businesses slowed down or shut down, and obviously hurt the bottom line for a lot of businesses. We as investors obviously experienced that initial hit in the market, but the businesses, like we were talking about, it was a couple months later when they really felt the impact to their bottom line because it was hard for them to do business. And, we came out of that recession really quickly, but it makes perfect sense. Well, I mean, basically that was a manufactured recession, and it may or may not have been necessary. I mean, that's not for us to debate, but, we basically, lives were put on hold, spending was put on hold for the most part, and it hurt a lot of businesses and the basically trade in the U.S. and around the world. So that's a recession. One of the most famous ones was the 2007 to 2009 with the housing market crash and the what was called the Great Recession.
Great Recession.
We all remember that, and we saw stocks pull back before on that, and then the .com bubble when that burst
at the first in 2001.
Right. And then the Gulf War recession, which happened in the 90s, 91, and it was kind of a period where we've haven't. I think that came after not experiencing many bad. We had a pretty nice little stock market run in the 80s, and had a growth in the economy and saw that pull back. But so the official recession is not something that happens all that often, but it happens once about every couple decades, a decade or so, and it's just kind of a part of it. The average, I think it said here in the article that the average span of a recession is 21 months. So, less than 2 years, and that's average. I mean, we just thought we've seen one that lasted 2 months or 3 months in the COVID recession, and then we've, obviously the Great Recession, that was about a 2-year period of time.
Yeah, that was significant. That's right.
But we all came out on the other end okay.
We did. And so the fourth one we wanted to cover today was depression.
Right.
And hopefully we won't see that. I think the Great Recession was about as close as we've been, definitely in our lifetime, and for many individuals listening have the opportunity to listen. And the Depression, the one that gets the most is the Great Depression back in 1929.
Yeah, so I mean, the depression is something that we obviously haven't experienced in our lifetime, and hopefully we won't. I mean, you can never say never, but that's when you've got extensive job loss. There's no opportunity to earn a living, with also just outrageous inflation. We're having some pretty high inflation right now, but I mean, you're talking about unaffordable price, like
Correct.
where
People were running on the banks during that
Right.
period of time, and things that were just not necessarily rational.
and we didn't quite have all the policies in place that can kind of stop that before it gets out of control like we may now. Now, there's always new ways of things happening, so you can't ever say that it won't happen, but recessions are fairly normal. Depressions are rare,
Right.
However, even though coming out of the Depression, we had one of the greatest stock market booms that we've ever had in our history.
Right.
So there's hope even after that.
That's
so
correct.
It's getting excited over 1/4 of downward moving. S&P 500 stocks is
Right.
maybe just a little bit irrational. It's understandable because, we just are not used to it. We've gotten a little spoiled, but.
Right. I can go on my little rant here just for a second. That's why we believe in good communication, because we don't want the clients that we work with to be average. And the average investor jumps out.
Right.
And they accept the potential losses of the downturn on their portfolio. And then what they do is they run the risk of not being back and exposed to the market or having growth-oriented investments in their portfolio, which it has shown that coming out of these times in which we've just referenced, that if you missed just the 10 best days of a market recovery, your return is, we're talking almost around 40% lower than it should be.
Sure.
If you would have stayed the course. Now, if you miss the 40 best days and you just aren't confident and are making those knee-jerk reactions, you're talking a significantly less return.
Right.
And you're making yourself an average investor. And that's why we believe in strong communication, because during these times that we just mentioned, people do get worried.
Right. And, it's, this is going to sound, I'm usually considered the wet blanket in the office, right? I'm the one that looks at, hey, what's worst case scenario here and starts there. But, trying to find opportunity in the markets like this and there's many ways to do that. Stocks are at a better price now than they ever were. So what that tells me is if you have money to invest, it's a good time to start looking for opportunity there. It's a good time to reevaluate if you truly are an aggressive investor, or if you're feeling okay right now, maybe you don't have enough risk in your portfolio, and it'd be possibly a good time with stock valuations possibly down to consider maybe adding some more stocks to your portfolio. But if it's if this is keeping you up at night, you need to find the opportunistic time maybe to consider taking some of the volatility out of your portfolio.
Right.
Other things is to look at your savings, or you will know probably in the next 3 to 6 months if you're having to dip into your investments while they're down, you probably don't have enough savings to be investing like you are to begin with, and that's something you need to have a discussion with your advisor to, how can I weather these times like this, because they inevitably, like we've discussed, will happen.
Right, right. They will. We can't control the returns of the market. We don't. The return is something an investor can't control.
Right.
But they can control three things: their time horizon, knowing how long you have the money you have invested earmarked, and then also what risk tolerance. Knowing that allows you to stay the course of your predetermined plan even through these market conditions, and then
right.
It allows you to control your behavior, which is possibly the biggest thing for an investor
right.
to do, and that allows you to avoid that panic sale mentality.
Right.
Because panicking is not a plan. You
Sure.
don't want to do that. So.
And so I hear you say this all the time, knowledge is power. Well, I think knowing these terms, that they are kind of normal things that happen. You can't really predict when they're going to happen. All you can predict is that they will happen.
Right.
And investing with that in mind and knowing that it's not the end of the world when a bear market happens and then inevitably when there's a bear market, there'll be a bull market. I think that helps you come out, like you said, be a better than average and a successful investor when you approach things in that manner.
Right. Well, we got anything else?
No, I think we've covered that. No more scary terms. The biggest thing you always tell people, I hear you saying, is just turn the TV off or watch something that's entertaining that is not news.
Yes.
Which is also basically just entertainment these days.
Exactly, because if entertainment is not something that causes you to worry and stress.
Right.
Turn that off and watch something that is actually entertaining to you. So we appreciate your time today. We do think that this topic was timely, and it's timely at any time because it covers the terms that are most likely that people may have questions about, if you will. So if you got any questions, feel free to call our office, or you can reach us through our online portal, our website at scretirementplanners.com. This podcast and all others in the podcast library can be found on our website. So make sure you go like and share. And if you don't work with us currently, we'd like to offer you a complimentary financial checkup where you come in and sit down with us. We get to know each other and your situation, and we kind of just take it from there. So
that's right. Yeah. And if there's a timely topic or just a term you run across that you think would make a good show, we're always looking for interesting topics to talk about. Send it, go jump on the website, find our email address and say, hey, I think this might be something I'd like you guys to talk about on your podcast.
That's good.
And we may just do that.
Yep. That's good. Well, thank you very much once again. And, you guys have a great day, and we look forward to hopefully interacting with you in some form or fashion here in the future. Thanks.
See you.
Securities and advisory services offered through LPL Financial, a registered investment advisor. Member of FINRA, SIPC. Southeast Retirement Planners is not affiliated with LPL Financial or registered as a broker-dealer or investment advisor.